And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. It is, of course, the second best day of the week. Brent Clanton here this morning. Surprising because we are in the midst of potential heavy rain today. So if you're driving to work in Houston, so this is a local weather forecast right now. If you're driving around Houston today, you might want to rethink your strategy. They're expecting up to 5 inches of rain today. So it's going to be what in Texas terms we call a gully washer.
Frog choker.
Frog choker, exactly. So anyway, but do be careful if you're out driving this morning. Roads are slick. There is going to be, spots of rain. If you can't see the curb, don't risk it, right? That's the...
Put your snorkel on your Toyota?
Exactly. I already have that. So
You don't?
I do.
Oh, yeah.
Yeah. I am set up for the apocalypse. When zombies come, I am so ready, right? I am so ready for zombies. I'm just, I watch all the movies. I've got everything set up. I'm ready to go. So
Excellent.
So, and then of course, that's why I work out regularly, because all I have to do is run faster than you. So, I'm all for The Walking Dead. Just shoot the guy in the leg behind you and keep running, right? So, exactly. So, anyway, got a lot of stuff to get into this morning. Of course, yesterday was the CPI report, so Michael and I will dig into that inflation report a bit this morning. PPI is out this morning. That is the Producer Price Index. So, here's the thing to watch for. Yesterday's CPI report didn't show a lot of inflation. We'll get into the details in a minute. The PPI report today will tell us between the two who's eating the tariffs, because this is the big thing that everybody's been talking about. Oh my gosh, these tariffs are going to lead to higher prices for consumers. Well, problem is that's only if the producers can pass that tariff on. So today's report will give us some good insight into whether or not tariffs are impacting producers or not. And again, we'll see what happens. India just reported much lower inflation. So we're not only seeing slower rates of inflation in the U.S., we're also seeing it globally. And that's because global economic growth is slowing. And, as we've talked about on the show many, many times in the past, what drives inflation is economic activity. It's supply and demand. It's always supply and demand. It's never anything else. It's not money printing. It's not the debt. It's not the deficit. That doesn't create inflation. Supply and demand creates inflation. That's it. At the end of the day, everything else can feed into supply and demand. But at the end of the day, it's supply and demand. And right now what you have is a consumer that is slowing down. And that's been evident in recent PCE reports. It's been evident in recent consumption reports, retail sales, etc. We're definitely seeing signs of a slower consumer. And we're seeing that also reflected in the employment reports. Companies aren't hiring as many people. Why? Because they don't have the demand. If I don't have demand for my business, I don't hire new employees. So again, pay attention to what the data is saying, because there is a trend of this, not just domestically, but globally as well. And again, so we're starting to see that slower economic activity continue to move forward. Outside of that, yesterday President Trump announced the kind of a trade deal with China. I was a little surprised myself. Not that it's hard to surprise me anymore, but talked about we've got to deal with China, but the tariff on China is still at 50%, right? It's 10% plus the previous 25 plus another 15. So I mean, it's on certain goods. They did get a deal done for rare earth metals, but again, that's still a bit higher tariff than I expected to come in. Again, I was a little surprised just personally. I thought it would be closer to 25%, not 50. But the market seemed to be okay with it yesterday when that announcement was made. So we'll see how this kind of plays out. Again, these kind of trade deals are still ongoing. And one of the big questions around these trade deals, of course, is when are you going to get all these done? Because you've got 134 countries to work through, and we've gotten a trade deal done with China at this point, which was the biggest one. That was an important one. But, again, we still have all these other countries to do. And yesterday, Treasury Secretary Scott Bessent hinted at the fact that 90-day window, we talked about yesterday a little bit about tariffs, that 90-day pause is rapidly approaching and we would have to do something. Well, yesterday, Scott Bessent hinted at extending that pause on tariffs for a period of time for countries that are acting in good faith. So in other words, as long as you're acting in good faith and we haven't got a deal with you done yet, we'll keep the tariff on pause. So again, this is, if you remember, this is something that we said previously, is that when that pause was announced, most likely that pause would just become more permanent. And that's what we're kind of seeing here as we kind of go forward. But anyway, we'll have to just keep a watch on that, because obviously that's going to kind of move markets, depending on what happens with tariffs and trade and all that type of stuff. But speaking of markets, here's what you need to know before the bell this morning. Markets had a rare down day yesterday. We haven't seen a lot of down days in the market lately. And this kind of really this relentless run that we've seen in the market since the April lows, it's been absolutely phenomenal. Market's up 3% for the year. If you had gone to bed in January and just woke up, you would not even know that we had a near 20% correction. I mean, it's been over very quickly. Markets are back in a very bullish trend. Here's the thing to be paying attention to. So first of all, it was interesting this morning. I posted this on X. We had a massive surge in the month of April in stock buyback announcements. It was well above the record of any previous year on record. And buybacks have really become a thing really since post the financial crisis, is where buybacks really started to take off, and it becoming a significant part of what's been happening in terms of the net buying of equities in the markets, really post financial crisis. This past month was the largest jump on record. It was actually quite phenomenal. But that's where a lot of this buying pressure came from for stocks. Now, that window is closing, as we talked about before. That starts on Monday, and we're about to get in July. So again, there's two things that are kind of going on that suggest maybe thinking about hedging your portfolio a bit, maybe taking some profits, being a little bit patient here, because two things are about to happen. First of all, buybacks are about to go into blackout, so we're going to lose that buying pressure. And right now, there is absolutely no love for puts. I mean, put hate is at very high levels right now. In other words, nobody wants to buy insurance for their portfolio. Why spend the money on buying a put if the market's just going to keep going up? Typically, when you get very low levels of puts being bought for, kind of hedging purposes, that's typically very near market peaks. And again, so we're about to get into earnings season. If we have any type of weakness in earnings, the lack of buybacks, and then of course anything that potentially triggers the market in seasonality, the end of June, beginning of July tend to be weak, just from a kind of a seasonality standpoint. So we're kind of in that really good position here for a bit of a pullback. Again, not a crash. The markets aren't going to do that. But if you've been looking for a better opportunity to put some capital to work, we may get that here in the next few weeks to the next month, as we kind of get into early earnings season and that buyback window kind of goes into full blackout mode. So it really kind of sets us up here for potentially a retracement back to kind of this cluster of support right around the 200, 100-day moving average. That's around 57.80. So again, the market's trading a little over 6,000 right now. Get a pullback to 57.80. That's about 200 points. That's a decent entry point. That deviation from the 200-day moving average and really the 50-day has gotten large enough to kind of let that gravity start to pull prices back here. So one of the things you may want to kind of start looking at in your portfolio is things that have had really big gains, particularly in areas of the more risky assets. If you take a look at the most shorted stocks, they have been the main drivers of this market return over the last few weeks. So a lot of short covering. That short covering's been completed. So again, in stocks that have had really, really big moves like Oklo, CCJ, others, Kamiko, especially in some of the more speculative areas, take a little profit there. And look for a pullback to re-add to your position. You'll get a better entry point here. It's just a function of time. So you just have to be a little bit patient. But don't forget to take a little money off the table, rebalance risk in your portfolio. That's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz. We'll talk about inflation. What does it mean for the Fed? All those kind of questions. We'll talk about that next on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome to the show this morning. Of course, Michael Lebowitz joining me. Mike, good morning. Welcome to the show. How are you?
Good morning.
Good
Morning. Good to be here.
Good. So yesterday, it was very interesting. We got the inflation report out. There was a lot of people that were underwhelmed by, the inflation report. There were a lot of people overwhelmed by the inflation report. Nobody ever seemed to have the right amount of whelm, right? I mean, they're either overwhelmed or underwhelmed. Nobody has the right amount of whelm. But it was interesting. The number did come in a good bit weaker than expected, 0.1 versus 0.3. So, I mean, it normally kind of everybody says, it's going to be 0.2 every month, right? It's every month is 0.2. But it was actually interesting. It came in a good bit weaker than expected on a lot of different fronts. And, now a lot of the analysts are going, well, just because the tariffs didn't show up this month, they're going to show up next month or the next month after that. And they're eventually going to show up. But one of the things that, you and I have talked about before is that, the impact of tariffs may not be as inflationary as a lot of people think. But before we get into that, just kind of what was your takeaway from the inflation report yesterday? Anything notable?
No, I mean, it was the fourth one in a row that was below expectations. And I think if you looked at cars, both new and used aren't tariffs, but new cars and apparel, they were both negative. Those are very easily tariffed. Those are goods that can be tariffed, and they were both negative. So either the tariffs aren't getting passed through or there's something else happening. But this is what I would say is the initial tariff CPI number.
Right.
And it was tame, slightly lower than expected. Expectations were priced slightly higher than where they should have been because of tariffs. So it's a little bit of both. I think let's just, before anyone says mission accomplished, let's just give it a few months. Let's wait to see how this fully fleshes through the economy. And let's look at PPI today.
Yep.
Because you're if you are going to see a tariff impact, you're more likely to see it in PPI first and then CPI. And then we can, I think you alluded to this earlier, start looking at what the difference between the two is, because that tells you a lot if companies are eating it or not eating it.
Right.
And that'll tell us about margins, about inflation, and what that means for consumers.
Yeah, this is something that, and again, you and I have talked about before, but I was reading a lot of articles yesterday, and a lot of the articles that were coming out, and particularly from the more the typically kind of bearish crew that are out there always, that have been, really talking about how tariffs are going to cause a massive recession in the economy, and you need to get out of stocks now because it's going to cause this massive spike in inflation. Of course, they were kind of scrambling to try to come up with a narrative. What was interesting is they started to pick on things that did show a big increase in tariffs. And this has been my point about tariffs for a while. Tariffs don't impact most of the things that we consume every day. Eggs, bread, milk, those type of things, because those are all non-tariffed items because they're mostly produced in the U.S. So they had to go to things like audio equipment, which had a massive spike. But how many people buy new audio equipment every day? Right. And this is one of the points that we've made, that you and I have both made before about understanding tariffs, is that consumers have a choice. I can delay a purchase. So say I wanted to buy audio equipment and the price spiked up, because of the tariff. Well, I can delay that purchase. I can source it out somewhere cheaper, or I just say, you know what, I'm not going to buy it. I'm not going to buy it. And I just go on with my life and do something else. So those consumer choices always have impact on the outcome of these tariffs. And I think that's been a very big overlook by most of the economists that have been, kind of putting out these headlines about how tariffs are going to be so inflationary, et cetera, is they forget about, at the end of the day, it really comes down to the consumer. And the consumer is clearly showing signs of weakness. We're seeing, rises in delinquency rates. We're seeing rise in late payments on credit cards. We're seeing, slower employment growth, and especially in full-time employment, we're seeing a drag in that. So, we're certainly seeing areas where the consumer is having to slow down, and that decrease in demand is also feeds into what that inflationary pressure looks like.
Right. I actually just saw this morning, the Atlanta Fed tracks the percentage of people that they survey they got raises or didn't get raises. And the percentage that didn't get raises was, I think it was 15%-ish. That's the highest it's been since before COVID. So, we're starting to get to a point where, forget the tariffs, that the employment data is weakening. It's not weak, it's weakening. It's below average. And when you start factoring in revisions, it's decently below average. So they announce a number, what would we get, 130, 139, something like that?
Right.
It's going to be, if it falls according to what's been going on for the last 12 months, that number was probably closer to 75 or 80. Yeah. They've been bringing them down by about 50,000 or more. And then 2 years from now, we're going to find out that 75 was really a 25 or a minus 25. So bottom line is, consumers don't have wiggle room they can pay for the audio equipment that went up 20%, but they're not buying oranges and apples and whatever else they would buy. And this is kind of the unfortunate part with the way, and we're just as guilty as everyone else. We focus number to number. What I would like to do is, let's just go in a dark room and wait 6 months. Get 6 months of CPI data, PPI data, GDP data, and then you can build your case as to what the tariffs did or didn't do to the economy. But when you're looking at it month by month, there are so many inconsistencies with the way they collect the data, and they admit it, and that's why they have these massive revisions. But just in the way that these tariffs slowly roll through the economy, affecting some things very early, and some things may still take 3 or 4 months to have an impact. And then the secondary impact, will people buy less homes or cars or other big ticket items?
Right.
So, it's staring at these numbers which we're forced to do, because it makes the market move for 20 minutes and we all, want to see that spike or drop or whatever it is. It's in some ways a waste of time.
Yeah. And I want to put this out there right now just so that, we've got this on record. So for next month and the month after, we've had 4 straight, like Mike said, we've had 4 straight months of below expectations in terms of prints. That's a fairly decent stretch of disappointment in those estimates, which means that economists are now going to start to ratchet down their estimates because they've been wrong for 4 months in a row. So they're going to start bringing their estimates down, which means that in the next month or two, we're going to have a number that comes in hotter than expected. So that's just the way it works, because when data trends in a direction one way or the other, analysts are going, okay, I was expecting 0.3 and I was wrong. I was expecting 0.2 and I was wrong. Expecting 0.3, I was wrong. Expecting 0.2, I was wrong. Okay, well, this month I'm going to estimate 0.1, and then it'll come in at 0.2. And it's like, see, it came in hotter than expected. So just be aware that this stretch of below expectations in terms of inflation we're going to have a hotter print in the next month or two. And that'll be because of either A, year-over-year comparisons, because most of this data we look at is on a year-over-year basis. So we're getting to a point where we had very low prints before. And so now when you have a low print here versus the low print before, it actually looks a little bit hotter than it was. And this is why Mike's talking about trends. Wait 6 months, and then let's look at 6 months worth of data, and you get a better understanding of what the trend of the data is. But then there's also a lot of seasonal quirks that happen in the summer as well. You get a lot of summer travel. You get a lot of summer, purchasing for going on trips. You get back to school shopping. So there's a lot of things that are going to potentially show up here just seasonality wise that are going to have a pickup in activity, supply and demand. And that's going to lead to that little bit hotter than and that's the key words, hotter than expectations in terms of CPI. It doesn't change the trend of the data, but you're going to get this hotter print. I want to say that now so that in 2 months we can come back and say, remember when I told you this was going to happen? That's just coming.
Yeah, and look, initially we could get a tenth higher, maybe even 0.2 higher due to some of the tariffs. But that's the first degree order of the tariff. Let's see how that works through the economy, because that's when you get the after effects of it. So again, let's just focus on, we'll come back in 6 months and we'll see where it was, and forget expectations, because they're subject to the whims of these economists. Like you said, Lance, they're gonna run it through their model, and they're gonna get plus 2.8. They're gonna say, I've been wrong. Let's just make it plus 1.8. Yeah. and it's inevitably gonna be 2.5, which was below their model, but above the expectation. And the market will say, it's above the expectation. Yeah. That's a really bad number.
Yeah. And the whole point of this conversation, if as you're listening to the show this morning, either on YouTube or in your car or wherever you are, is just the whole point we're trying to make here is don't get wrapped up into these month-to-month numbers. They're meaningless. What is important is the trend of the data over time. And this is why you look at annual rates of inflation, annual rates of growth, annual rates of this or that or the other thing, because 1 month to the next doesn't mean anything. But the longer term trend of the data, where's that going? Inflation was 9%. It's now 2.4%. There is a clear negative trend to inflation in the economy. If you take a look at inflation, there's a very high correlation between inflation and economic growth. What's economic growth done? It's gone from 12% nominal down to 4%. So things are slowing, right? We've clearly got a slowing trend in the economy post-pandemic, but these things take a very long term to mature to their final end of where we're going to get to. And, this worrying about 1 month to the next is really a fool's errand. Focus on what's important in your portfolio. We'll talk about that when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
In the chat, they've been going on about first PCs.
Yeah.
And if you had a PC with a floppy drive.
The Real Investment Show podcast.
My first actual quote computer was a Tandy 1000 with dual 5.25-inch floppy drive and a whopping 512K of memory.
Same show, your schedule.
I felt so fortunate in college in my dorm room to have my own computer,
right,
with my own printer.
You were a spoiled rich kid.
Well, I don't know about that.
At realinvestmentadvice.com.
Instead of being in the bar going, hey, what's your major? He's like, hey, I have a computer with a printer.
Why don't you come check out my dot matrix? That's right.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now, with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Of course, it is Thursday, second best day of the week, and ready to wrap it up. Friday's right around the corner. And we'll also be halfway through the month. And as we talked about before, starting next week, we're going to lose stock buybacks. That window will start to close. And then before you know it, we'll be back in earnings season right here at the beginning of July and be right back into the mix of everything again, right? And then so, you know, one of the things that we've talked about before, and as we left off in the last segment, is when managing your portfolio, the key thing is to focus on what really matters. And again, we get so swept up into and Mike and I have just spent an inordinate amount of digital ink lately, you know, discussing narratives. You know, it's the debt, it's the deficit, it's, you know, tariffs. And, you know, these narratives are constantly changing. And because when the narrative doesn't form into something, you know, people go, yeah, I've heard you say that before. And, you know, yeah, we're on to something else. And, you know, and that's what the markets do. The markets start to factor these things in pretty quick. And as we've talked about before, I just did an interview with Michael Campbell for Money Talks up in Canada this past week. And this was part of our conversation, is that, you know, when markets know about something, and we've talked about this on the show before as well, but when markets know about something, when somebody starts talking about something, whether it's the debt, it's the deficit, it's tariffs, whatever it is, the market, these millions of minds that are out there, the computer algorithms, the all the data, the actual human traders that are out there, the computer programs that are designed to take in all this information and build trading programs out of that data, factors all that stuff in. And the market adapts to that information very quickly. It says, okay, I know what that is. I've priced in for that. Now I'm on to the next thing. And ultimately, at the end of the day, what markets focus on and what matters is earnings. Because markets are constantly bidding on what the forward expectation for earnings are going to be. And if earnings are expected to be better, then I'm willing to pay up for future earnings. If future earnings are expected to be a lot worse, I'm going to have to revalue my portfolio based on that expectation for weakening earnings in the future. So one of the key things that it's important to remember as investors, step back from all these narratives, and especially, the really bearish narratives and even the really bullish ones, right? I mean, Ed Yardini, markets are going to 50,000 next month. And I'm exaggerating, but he's always very bullish. Tom Lee is always extremely bullish. That's fine. Those are good narratives. And then you've got the other group of people, that are super bearish, and you can buy into that. Reality is always somewhere in the middle, because when we start talking about outcomes and the potential in managing risk in your portfolio, et cetera, we have to navigate markets for the center part of that bell curve, right? These tail risks that are out there, the end of the world tail risk, the market's going to the moon tail risk, those could certainly happen. But those are very, very low probability events. Reality always tends to occur somewhere in the middle of this. And Mike, this is what makes it challenging, for us, for two reasons. One, because we're just trying to navigate, manage the portfolio, but then also we have to deal with our clients, which are susceptible to all these narratives. We get a lot of our clients that call us like, hey, I heard this from this person, or I heard this from this person. And a lot of these people have credibility, Ray Dalio and others. And, that weighs on their emotional kind of state as they're seeing, markets move up and down, et cetera. So really we've kind of got the double whammy. If we were just in a silo, just managing a portfolio, it'd be easy. But, we also have to be psychologists half the time. But this is the hard part for managing money is stepping back from these narratives. In fact, and again, inflation, the trend of inflation, et cetera, tariffs, whatever it is, stepping back from these narratives and going, okay, yeah, but what really matters right now in the portfolio? Where is the market headed to next?
Let me ask you a question, Lance.
Sure.
If we could come in every 2 weeks on a Friday, and we just spend all day. We look at markets. We look at what's happened over the last 2 weeks. We talk about things. We do analysis, and then we make whatever investment decisions we make every other Friday.
Yep.
The other 13 days of the 2 weeks, we're on a beach. We don't even have a clue what's going on in the world.
Right.
Would we be better investors? And by we, I mean not just me and you, but almost every investor.
Let me rephrase that for you real quick, because I agree with what you just said. But forget every other Friday. We came in at January the 1st, and then we come in on July the 1st. And this year is a great example of that. If you and I had gotten together back in July 1st, we had positioned the portfolio this year. We said, hey, this year is going to be a year of more volatility. And, we're expecting, lower rates of return, higher volatility. You and I both wrote about this. We positioned the portfolio at the beginning of the year expecting this. And if we just gone to the beach and come back next month, would we change anything in our portfolio right now?
On the margin, maybe, but I think you're right. We both thought we were in for a roller coaster.
Yeah.
And what we wouldn't have known on July 1st is whether we were at the top of the coaster or the bottom or somewhere in between.
Right.
And even then, that would have swayed our decision, right?
Mm-hmm.
Like if we would have come in and it was way high, we would have been sell everything. We're still on the roller coaster. We're going back down, or vice versa. Load up the truck. We're at the bottom. And this is, we talked about this. CPI is only once a month.
Right.
Markets are nonstop. You're bombarded with markets, and it sounds like soon they want to go to 24/7 trading, which will make it even worse. And that's what drives the narratives, right? If if the market only posted its returns once every 3 weeks, the narratives, I think, would be more in line with reality. Instead, here's an example. I woke up in the morning and Boeing's down a lot. One of their planes crashed in India. It's a pretty sad story. Mm-hmm. Stock's down a lot. All of a sudden, you get a bunch of narratives as to what that means. No one knows what it means yet. We know a plane crash. Was it the pilots? Was it a Boeing problem? Was it something else? The narratives start flying to explain why Boeing was down. 15 point, about 7-8%, whatever it is. And, if we come back and we look at the Boeing story in 2 weeks, we'll know, we should have a pretty good idea of what happened, who's at fault. Is that bad for Boeing stock or isn't it? Mm-hmm. And maybe whatever happens today in the next few days to Boeing stock just gets erased. But because we have to assign a story to every tick, to every uptick, to every downtick, there have to be people that have to explain why CPI was bad, why CPI was good. It just creates a ton of noise. And the noise is very distracting from an investment longer term wealth building exercise.
Right. And I think Boeing is such a great example of why you and I talk about risk management. Brent, can you bring this chart of Boeing up for me? Brent's going to bring up a chart of Boeing, and Mike knows what this chart looks like because he was obviously looking at it this morning. But, this is the thing that Mike and I talk about a lot in terms of managing risk in portfolios, which is when things have a really big run, don't be afraid to take some profits out of it. And that doesn't mean sell everything. It just means, hey, I owned a position, I bought it well, it was 3% of my portfolio, it's now 4% because it's had a big run. And when things get very deviated from means, they always correct back to the means. Now, the reasons for those corrections are always varied. But there's always a reason why something happens, right? There's an announcement, we're using Boeing this morning. It's a very tragic accident. 280 people are expected to have died. It's horrendous, right? And so, my apologies for using Boeing. It's just a good example this morning from an investment standpoint that things happen, good, bad, whatever things happen, and it works in the opposite. When things get really, really oversold to the downside, something generally happens that will cause markets to come back into that stock. But this is why Mike and I talk about a lot. Learn how to take profits, learn how to rebalance risk, particularly when things get very, very overbought and very extended. For some reason, it always occurs, some news item comes out and it causes an overbought stock to contract back towards its moving average. And that's what ultimately probably will happen with Boeing over the next few days. Boeing has a history of problems with planes, doors falling off of them, etc. So this is going to be another one of those situations that will probably weigh on Boeing for a while. I'm going to just leave the chart up, Brent, just to give you perspective, right? You take a look at this really strong rally in Boeing. This is a weekly chart of Boeing, which Boeing really hasn't gone anywhere. If we move to a monthly chart, this was that previous huge drop-off was when the doors were falling off the Boeing airlines, right? So, and there was all the investigation, everything else, and the stock hasn't gone anywhere since then. So again, it's important to also have perspective over when you're looking at a stock and say, oh man, Boeing's really running right now, I need to be into Boeing. Be sure and stretch it out a little bit over time and say, is this just a rally within a downtrend? What's happening? But these are the things that we do. We talked about this morning. Brent, just leave it here for a second. I know. But, Oklo, Kamiko, a lot of these nuclear plays that we've been talking about lately, they're extremely overbought. Now, whatever causes a pullback will happen. It's happened before, it'll happen again. So again, if you're long these stocks, for whatever reason, learn to take some profits and rebalance risk. And when we come back with Mike, we'll talk a little bit more about that practice and about how to manage risk in portfolios and how to be a better investor in managing your own money. All right, quick break. We'll be right back. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Talk a little bit about managing portfolio risk, those type of things. So Mike, we were just talking a little bit about, and unfortunately just today was a bad day to use Boeing, but it's a good example of learning how to take risks because you never know when these unexpected events are going to occur for whatever reason, and we never know what they are. Stocks are a stock is doing fantastic, and then all of a sudden they come out and they announce some impact to earnings, or there's a lawsuit that's filed against the company for whatever reason. And it always seems to occur just, when the market, when that stock is the most stretched to the upside, and it's like, oh, this stock's never go down again, and then something always seems to happen. But this is the point about managing risk and, why it's a challenge, to do that over time.
Well, I think part of this is, I think you said this earlier, the market has all the information that it has. So the market, collectively, hundreds of millions and billions or whatever the number is of traders are putting a price on this, buying and selling, and trying to get that price to match the news that they know, to know what they know about the company. However, sentiment starts to take charge, and people see a line that's going up 45 degrees, and they ignore the news, they ignore the data, and they just say, I'm buying because this is going up. Look at Boeing. Boeing's been just going up. Boeing looked really nice. What's changed about Boeing over the last 6 months? And I haven't watched Boeing for a while, but I'm sure there are some things that have changed. But did it warrant for that stock to keep going up? And what happens is the sentiment drags that price too far above where it should be. And ultimately, it comes back down to that more sustainable moving average, whether it's trending up or trending down or whatever it is. This works to the downside equally as well. And you basically get a return to the norm. And sometimes it's an event, or sometimes it just starts trending lower and working its way towards that trend or that moving average or whatever it is. But, going back to that graph on Boeing, there's two lessons there. One, if you own it, take profits. Two, if you want to buy it, if you think Boeing is the place to be, have patience. patience is equally important. That stock was very overbought. Look, no one knew there was going to be a plane crash. And again, no one knows who's at fault and whether this is going to affect how it's going to impact. It will impact Boeing, but no one knows the monetary impact on Boeing and the downstream effects. Does this force them to recall a bunch of planes? I mean, it could be pretty bad or it could be very minor. So have patience when you're, Oklo is a great example. I think they issued shares. They were up. It was up 15 or 20% yesterday.
30.
And then after the close, they said they were going to issue shares. And I know last night, I haven't seen it this morning, it was down 5 or 6 or 7%. So again, you don't know what the event is, but you know when sentiment and narrative stretch something too far from its fundamental trend. And that's what's important. And that's where you either take profits or have patience.
Well, and again, and the key thing that we're talking about here is when we say take profits, one of the things that investors, when we say something like take profits, they go, okay, Lance said sell everything, so they go sell everything. That's not taking profits. Again, we talk about position sizing, we talk about risk management. When we look at our portfolio, we look at our portfolio in multiple ways, but we look at a position in the portfolio, how is it weighted relative to the S&P 500? Because again, to say we own, Microsoft, what's the weight in our portfolio relative to its weighting in the index? Now, if we are a really strong believer in Microsoft, we may choose to overweight that position relative to the index. If we're not so sure, we may underweight it relative to the index. Some things we own because they are part of the index, and the index drives, the portfolio itself. So there's a lot of decision making that goes into managing risk in a portfolio, but very rarely is it a buy all, sell all decision at any one time. Even when we're buying a position, we may start to scale in and buy 1% now, 1% later, those type of things, in case we're wrong. But that's all part of that risk management process to keep mistakes from being overly impactful to the portfolio. And Mike, that's really the key thing here is we're trying to focus on is not making overt mistakes that have an outsized impact on your portfolio outcomes.
You said this really well in the last weekend's newsletter. We are being patient right now. We would like to add to our exposure. We have less exposure than is optimal. We would like to add it, but we're being patient. Kind of like that Boeing stock. If we wanted to buy Boeing, we're just saying let's let it work this overbought situation and be patient. So what you said this past weekend was something to the effect of not that we're necessarily, we'd love to buy cheaper. That's the goal, right? But at the end of the day, what we're really trying to do is get more comfortable with the risk-reward trade-off at that point in time. So we'd rather buy it when we think the odds of it going higher, the percentage that the stock could go higher over, say, the next few months, 6 months, whatever it may be, is equal to or greater than what we think it can drop. So if you buy it closer to like the 200-day moving average, forgetting all the other fundamentals, narratives, everything else, you're in a better situation than if you're buying it 20% above that 200-day moving average. So it's really risk management and not as much as, again, we'd like to buy it at lower price. That's the goal, but we'd also like to buy where we have less risk, more return potential. And at the end of the day, managing the return and the risk is what gets you to build wealth consistently over time.
Yeah. And that's kind of the point and again, the point you're making is say, I wanted to buy, again, just talking about Oklo as a second, because they had a huge rally yesterday on the news that they're going to supply power to the Air Force. So to an Air Force base, sorry, not the Air Force entirely, but to an Air Force base, that was great news for them. Stock was up like 30%. Stock's 3 standard deviations overbought. Let's just assume for a moment that the stock just goes sideways for another month or so. In another month or so, if it just goes sideways, it doesn't trade anywhere. The overbought conditions will get worked off. The risk reward for owning the stock will be much better than it was than buying it yesterday. So the news comes out, I could have bought it yesterday, But the risk is, and again, the stock will be down this morning. When it's that overbought, the risk is that you get a pullback. But if the stock just moves sideways for a while, work off those overbought conditions, then the risk reward, even though I buy it, maybe even a potentially slightly higher price than I could have today, maybe in 2 months, I buy it at exactly the same price or maybe even slightly higher. Because it's had this period of time to work off that overbought stretch condition where you've had this imbalance of buyers and sellers, and you get that back into balance, the opportunity to make money from that point is better than it was today. And that's the hard part for people, Mike, to your point. This is a hard part for people to understand, is that, yeah, I could have bought it there. And hindsight's a terrible way to invest money. It's about where you are now, and focusing on where you are now, where the next opportunity is, and measuring that risk and reward for that dollar invested that becomes the most important part of the game. And again, we as investors, we spend too much time looking in hindsight, going, I wish I could have, I wish I should have, rather than looking at what the opportunity is that exists today and where it will be in the future.
And it also helps from a trading perspective. Say you bought Boeing a couple days ago, and now it's down 8-10%. You may be tempted to sell it. Look, it's not going out. It's not going in my favor. I'm out. And then the stock goes down another 5% or 10%, and then it goes back up to where it was going. Had you had the patience, you would have just waited. Yes, you would have got it cheaper in this case, but you would have got it without that risk of it dropping 5 or 10% and shaking you out of the stock, which may have been a very good long-term call, but you got shaken out because when you entered, the risk was higher than a potential return. So, I think we've talked about a lot of important things here, right? Take profits, patience when you're trying to buy. Come in once every 2 months instead of coming in every day. We got to sell Connie on that one. Maybe the 30th of every month will come in. Yep. Look at things over the slightly longer term. Don't get so focused on how's the S&P going to open today? What's CPI going to be? Will Chairman Powell mention the word inflation 6 times or 10 times? All these little things can really impact your trading and your mind, and can be very harmful in your investing fortune, in your success.
Right. Well, again, we talk about this a lot. Again, if I could get investors to, if you could get investors to turn off the television during the day, and to your point, just look at, open your statement once a month, once every couple of weeks, you would be so much better off as an investor. But again, there's just so much media in your face all the time. And again, there's so many people, purveying, one narrative or another to get clicks and views and those type of things. And it's great, it's fine, but just understanding how that narrative is actually going to apply to markets over time and how markets are actually going to respond to it, so critically important. And again, this nonstop daily feed of information it just overwhelms investors a lot of times and moves them into making emotionally based mistakes, which is why we spend so much time on the show talking about psychology, behavior, because those are the things that lead to poor outcomes for investors. Now, if you're day trading, if you're a day trader and your hold time is minutes to hours, then yeah, forget everything Mike and I just said, because all that matters is what the market's doing from 1 minute to the next, and that is all headline driven. So if you're day trading, ignore everything Mike and I just said. If you're investing and you want to build long-term investment success, then pay more attention to trends and less to narratives, and you'll be much better over time. All right, wraps up the show for the day. Be back tomorrow with Financial Fitness Friday. We'll return on Monday as well. And we'll start, wrapping up the month of June already. It's hard to believe, but right around the corner. All right, y'all have a great day. See y'all back here tomorrow on the next edition of The Real Investment Show.